Welcome to Retirement Answers Today. I'm your host, Jim Martin, registered financial consultant and author of Your Retirement Playbook. I run a successful financial planning and investment management firm, and I'm here to share with you what I've learned helping hundreds of families retire successfully. Retirement Answers Today is all about helping you answer the big retirement questions. If you like the show, share it with a friend, hit subscribe, and leave us a 5-star review. Are you ready? Let's do this. Hello and welcome to Retirement Answers Today. My name is Jim Martin. I'm your host. I am joined today by Sam Benson. Sam is a financial advisor at our firm. Sam, you have the distinct honor of being the first co-host or first guest on our podcast in the history of it. So I hope that's something that you're really going to hang your hat on for the rest of your life. It
is an honor. Genuinely, I appreciate you having me on to talk to you today.
Well, we're gonna cover some big questions out there that folks have, and if you've been around in this business long enough, you know that you're going to see a market decline. If you're an investor, you see markets go up and down through your career, and this is no difference. We've seen this happen countless times in our history, but this one kind of feels different because we haven't seen it for a while. So we have a lot of people out there that are asking questions about the market. Should they be concerned? Is it going to go to zero? What should they do? What action should they take? So I really want to unpack some of that, Sam, because I know you're on the front lines like me. You're talking to a lot of people who have these concerns and questions, and a lot of folks are not hearing from their advisor right now. You know, they've been doing it on their own. You know, heck, in 2019 and even 2020 and 21, you could throw a dart at the dartboard and make money, and then all of a sudden, maybe your genius is worn off a little bit, and people have questions. Are you feeling a little bit of that? You seeing some of that, Sam?
I am. It is a little bit different. I think people are pretty comfortable when they see, fluctuations of 3 to 5% in the market. But when you get this combination of significant downturn over a period of months where, 100,000 is turned into 85,000 or, 80,000 on the statements. And then you get the news media talking about everything they can do to get eyes on screens and clicks on the website that tends to upset people. And so, we are getting a lot more of those kinds of calls, those kinds of questions. I've gotten questions like I've never gotten in my career. Is my money go to zero, or what happens to my holdings if they go to zero, and questions like that. And it is a time when people are genuinely reassessing things, and that's not necessarily a bad thing. Sometimes we tend to overstate how comfortable we are with volatility, and when we see some real pullback, maybe that's a good time and opportunity to assess how much risk we're taking and what we're comfortable with.
Yeah, I think that's a good point. And let's start with, is it going to go to zero? Because I think that's a big question people have, and that's a concern that a lot of investors hold. And I'm not sure they quite understand what would happen if their portfolio went to zero. So let's imagine, Sam, you had a globally diversified portfolio with large cap. And for folks who don't understand what large caps are, those are the largest companies out there. So if you see like an S&P 500 fund, that's what that is. That's a fund that has the 500 largest companies in the S&P 500. And you have mid caps, mid-sized companies, and small caps, small companies. So Sam, let's imagine all of those went to zero. What does that mean?
Well, I think, basically that's an apocalyptic scenario.
Right.
It can't happen. It never has happened in the Great Depression.
It's possible, right? Like if we had a global nuclear war, or
Right. The economy, nation states, entire industries, the entire banking system gone, then theoretically it could happen.
But your money's not worth anything then, right? At that point.
I like to live in Realville. I like to live based on what we've actually seen historically. The Great Depression, the mid 70s crash, the 81 to 83, and, something that I actually lived through, which was the 2000 to 2003. Those are more realistic scenarios. I was in the financial services industry during the global financial crisis. And so it helps sometimes to tell people, you're not going to go to zero. If the fund you owns Caterpillar, it's not just a number on a chart. It's factories, it's, heavy equipment. It's a backlog of orders. It's all their holdings. So there's something called the book value of a stock. So they really can't go to a zero value. An individual company can. That's happened. That happens all the time, unfortunately. But if you have a quality, well-diversified portfolio, your money's not going to go to zero. It's more likely to see a drawdown, and those tend to be temporary and fairly short-lived.
Yeah, and if it did go to zero, let's play this all the way out. You let's imagine your portfolio of and by the way, Sam's point before is really well stated. I think, companies, we've seen companies go to zero all the time. That's just part of a market. Remember, a market is up and down in a trading cycle. But if your portfolio, which hopefully it's well diversified, went to zero, that's a whole nother thing. That means the U.S. economy's collapsed. I mean, everything's collapsed. Everything's went to zero, and your money's not worth anything at that point anyway.
Right.
Either. So I don't.
The cash under the mattress doesn't help you in that.
Right. It's only good for firewood at that point, or lighting firewood up. Lighting firewood up. At that point, your money's not worth anything anyway. So I don't buy into this idea that markets are going to go to zero or you're going to go to zero. In fact, think about this as a country. I mean, I'm not saying there's not headwinds out there for the economy. I'm not saying we don't have inflation. We obviously do. I'm not saying we don't have rising prices in gas and food, and that's not scary. I'm not saying Russia and Ukraine aren't duking it out. But we're not in a Great Depression, and we're not in a world war. And there's a lot of positives out there in the world. Americans today live better than the kings of the 1800s did. They have air conditioning.
Absolutely. Even and not to make light of some of the challenges that we are facing. Inflation right now is real. I see it every time I go to the pump, every time I go to the grocery store. And, it helps to remember there's a difference between market performance, investment performance, and how the economy is doing. Those are economic factors that we don't like, but you're spot on with that. It really is the best time that people have ever been alive in terms of medical technology, in terms of our access to things that make our lives better, access to information. The U.S. economy, the employment rate is still historically low. And it's a good time. And one of the things about investing that I always try to remind people is that the market rewards the perpetual optimist. And you can really get into this loss of perspective when you see this sharp downturn in your statements. January I had $100,000. April 1st it's $85,000. That's an April Fool nobody wants, right? And you can look at that and you get this kind of whole recency bias where you think what's happened recently is what's going to continue going forward. And it doesn't necessarily or even usually work. More often than not, when you get these rapid drawdowns, they can run for a period of months usually. But the market over time will reward you for staying in it. And getting out is oftentimes, as much as it satisfies us or wants to satisfy us emotionally, it can really be the absolute wrong thing to do once you start to see your statement go down. A lot of times the damage is already done at that point. You're just locking it in.
Yeah. So what do you say to people? Sam, when they say, I don't have enough time to make it back, so I need to make changes right now because I don't have enough time?
Yeah, that's a great question. Well, I think, it's the old saying, an ounce of prevention beats a pound of cure. I think the first thing you've got to look at is, one, were you properly positioned to begin with? And unfortunately, not everybody is. We try to make sure that our clients' goals and risk tolerance and horizon, that we've got that all dialed in before we have a market downturn. But let's just say you were the person that, so to speak, went out and drank too heavily, and now it's too late to say don't drink when you've got a hangover, so to speak. So let's say, I don't have enough time to recover. I've got to get out of the market. Well, I think what you do is you unpack everything and you start talking about realistic time horizons. How much money are you going to need for the next 6 months, 12 months, 24 months? And then we look at what the conditions are in the market. We look at what your tolerance is and how much you're realistically likely to need. And we build around that. And, if we invest for decades instead of for years or for months, and if we can help a client feel better about what the near-term horizon is going to look like for them financially, I think it really takes a lot of that stress of a short-term loss off the table. Say, okay, I've got enough money in savings in the bank, or I've got enough in, short duration bonds or whatever to get me through the next 18 months. Well, Russia, Ukraine's not going to last forever. Gas prices are not going to skyrocket forever, and inflation's not going to last forever. At least it never has, not in the United States. So, we can take steps to address the short-term issues while staying the course or improving the course long-term.
Yeah, I think that's well stated. And there's a couple things I just want to point out. We as advisors, and I think you as investors who are listening to this, you have to think about things in the context. If you thought the market was always going to go up, why didn't you put all of your money in the market? But the reality is most people, not all, but most people don't do that. They build a balanced portfolio, a 60-40 portfolio, an 80-20, and they've got some buffer dollars in there, and you expect the market to go down. And while in our world, we don't like when the market goes down, we certainly plan for the fact that it will go down. And I think Sam said a couple things in there that were really important. And one of them was that, ultimately you need to have a realistic timeline on what your time horizon is. If you're 60 years old, the market going down right now does not mean you don't have enough time. Your life expectancy is another 25, maybe 30, 35 years. You have plenty of time to recover. Now, the other thing is, from a bucketing perspective, Sam kind of alluded to this, is that when you're investing your money, all of your money is not invested the same way. So we should have what we call non-correlated investments. And what that ultimately means is, if the market's down, we need to have some investments that are not falling at the same pace or as volatile as the market. So if we need liquidity along the way, and that's what retirees are concerned about, right? Like, the market's down, I see my statement go down and I need access to my money, and now I'm going to have to sell at a loss, which feels inherently bad because we've always been taught not to do that.
Yeah.
That's why ultimately having non-correlated, safe money to withstand these things are really important. And I like to tell people, I don't know that this is a catch-all for everyone, but if you're nearing or in retirement, I think you should have 3 to 5 years of dollars that are going to be unscathed by volatile equity markets. And you need to look at having some money that you can access when the market drops and not take any risk, because that's really what we're trying to do at night, which is when we retire, we want to sleep better ultimately. And I don't know if you feel that same way, Sam, but that's the way we, I try to communicate with our clients, is just making sure they understand that if the market drops, you just need to have some money that's non-correlated to the market, so you can withstand the Russia-Ukraine. Yeah,
that is the importance of asset allocation, because it's that ounce of prevention. If it's done right to begin with, your portfolio has that time to recover built into it for everyone.
Yeah. Exactly. So those are the answers to the big questions. I think the big questions is, what if it goes to zero? I'm not going to have enough time to make it up. I'm really worried about the market. And let's unpack the worried about the market, because are people right to be worried about the market? What do you think?
Yeah, I think in the short term they are. In the short term, there's a lot of challenges. And prices, and when you actually have these conversations with individual investors, they get it. Over the last 2 to 3 years, the market has really been juiced by a couple of things. One, artificially depressed rates that sent money towards equities rather than fixed income. So the interest rates were too low. The second thing was just all this printed money that went out there. So you started seeing stock market prices climb, to borrow from Greenspan, exuberantly over a period of time. And I think we've all seen that. And whether we wanted to admit it or not, you kind of looked at that and said, okay, this is getting a little bit overcooked. So part of this is a natural correction. And then I think part of it also is the fact that, we are due to have a lowering of the market. And your average, or the definition of a bear market is, a 20% loss. And I think we're there. The bigger question is, should people be worried in the long term? And that gets back to what we were saying earlier. And my answer to that would be no. Historically, as I said, the market rewards the perpetual optimist. I don't think the outlook is that great over the next 6 months, maybe 12 months. But beyond that, I do think it's going to recover, because the things that are driving this market currently they're temporary issues. Russia, Ukraine, for example, isn't going to go on forever. It'll get solved one way or another. So that's kind of my thoughts on that. What are your thoughts?
But yeah, I don't have any, I have no guess over the short term. People have asked me my entire career, what do I think the market's going to do? And my answer is always the same. I think it's going to go up and it's going to go down. I just don't know in what order.
Yeah.
And then the next one, and you kind of alluded to this, Sam, was, people will ask me, how do you feel about the market right now? In short term, I'm always nervous. I mean, even when the market's doing really well, I'm always nervous. Long term, I'm completely.
That's when I'm most nervous. Yeah.
Yeah. Short term, I'm always nervous. Long term, I'm optimistic. Look, we're talking about the United States of America. People get up every day and go to work. They try to do better for their families. They earn more. They just take a look at the unemployment numbers that are out there right now. They're astonishing. Even with all the headwinds, we're still, you can still go find a job anywhere. So I think there's a lot of things to be optimistic about. I don't know when the market turns around. I don't really care either. I know that sounds crass to people who are nervous. It doesn't really matter. We know that it will. We just don't know when. And the important thing is to take a long-term approach. Investing is not a short-term endeavor. It is a long-term endeavor. And the most important thing to do is sometimes just sit on your hands, turn off CNBC, stop reading the newsletters. Remember, people are trying to sell you things. They're trying to get you to take action.
Absolutely.
Or buy things, or the news channels themselves. Guess what they're trying to do? They're trying to make you tune in every morning to see what the market's going to do every morning. Yep. And they know in a negative market, guess what happens to CNBC ratings when the market's bad?
Yeah, their ratings go through the roof and their advertising dollars go through the roof. We saw this, we see this anytime there's a spate of bad news. I mean, whether it's, pick your headline. This is what happens. And one of the things that can do that's so dangerous is it drives us towards a negative emotional state. And we don't always make good decisions when we're like that. When the news is saying panic, 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 just some of the stuff that went on related to COVID is a good example of that. And I think if you can just tune a little bit of that out and know that generally speaking, your emotions and what is the intellectually right thing to do are often especially in volatile markets, are moving in the opposite directions. So in this, I want to qualify this because it's a little bit different for retirees who are no longer out there actively earning. And that's a different challenge. But especially for people who are currently working, is to remember that markets must necessarily move in two directions, and you should never stop investing. And so when you do see these kinds of falling markets, it's so important to remember that what you're seeing is more attractive valuations, i.e. go in and buy because you're buying things on sale. And that's something to remember too. There is a silver lining to every cloud, and even in a down market, you should be buying in. I certainly am.
Yeah, I think let's talk about that. And I think investors understand this, right? Even if they have the emotional response to the fact the market's not, and by the way, I have it too.
We all do.
We do not like the market being down. It's not a fun time as an advisor. It adds a lot of workload to us, but that's okay. That's our jobs. We enjoy that part of it. But let's talk about what investors should do, because I think these are great opportunities for investors, like incredible opportunities. If they can get the for lack of a better term, the head trash out of there, they can really realize some real opportunities. So Sam, I'm going to throw this out. Investors right now, they should really be considering Roth conversions. This is a great opportunity. We want to convert when the market's low. They should also be considering tax loss harvesting. Taking a look at your non-qualified holdings, and if there's opportunities to tax loss harvest, if it makes sense, remember, always consult with an advisor, consult with a tax professional before you take any action. But these are really good opportunities. What other things should investors be looking at or doing when the market turns south, Sam?
Well, I think anytime you have a period of market change, I think it's time to sit down and have a financial plan done. If you've got one, that's great. Sit down with your advisor and do an assessment of it. Reassess what your risk tolerance is. Reassess what your goals are and your capacities are. So I think adjust your plan. The second thing is, if you don't have one, get one. You mentioned two of the big ones, which is Roth conversions, so that you can take money that later on is going to be taxable and, take your tax penalty now and, take advantage of what will be tax-free income later on. So I think that's a great one as well. And also, if you've got that liquidity cushion, if you've got a war chest or a safety net or whatever you want to call it, and you've got extra cash laying around, look at what's on sale. Look at where there's some areas for attractive investing. And of course, I'm not going to make a specific recommendation because all that is, depends on the individual.
Sure.
But that's another thing I think you can be doing is just put some cash to work for you.
Yeah. And the most important thing you can do right now is probably not make changes to your portfolio unless really needed. Look, I'm not going to tell you that if you've taken an excessive amount of risk and all of a sudden you're in a position where you're down significantly, you shouldn't make changes. But the most important thing to do, what Sam alluded to, is have a plan, understand how your investment's working within the plan, make sure your allocations are risk adjusted based upon your risk tolerance and your time horizons. And if you do those activities, I think you'll have more success. And I think the real key is not to make emotional decisions here. Don't make an emotional decision. You don't know what the market's going to do. Nobody on TV knows what the market's going to do. In fact, nobody on the planet knows what the market's going to do. Tomorrow morning, when you wake up, the market's going to do what it's going to do. Not because of me, not because of you, not because of Sam, not because of some talking head on CNBC. So you have to make decisions with your goals in mind, and it starts with a solid financial plan. It really starts with making sure that you understand that you have the right allocation. And I really think Sam made a really good point earlier where he talked about, this is a great time to really reassess your risk and get that dialed in. And if for the last 3 or 4 years you've been taking really high degrees of risk, more comfortable than what you think, more risk than you thought you were comfortable with, this might make sense to change them. And if you have money on the sideline, or this is the exact opposite, sometimes you'll take a look at a portfolio and realize, wow, I'm really heavy in fixed income, and I'm not really. Maybe I need to take a little more risk, especially when the market's down. I don't know what your answer is because everybody's different. Mm-hmm. I really highly encourage folks who don't have a plan like this, sit down with an advisor, have a conversation, make sure you get the questions answered. Folks, I really want to thank Sam for being here today. So Sam, I hope this was an enjoyable first experience being the guest.
It was, Jim. Thanks for having me on. I really appreciate it. It was a good conversation.
Yeah, and if you have questions, make sure to go out to our website at retirementanswerstoday.com. We thank you for listening. Until next time, have a great week. As we wrap things up today, I want to invite you to visit our website, retirementanswerstoday.com. I also need to review with you the things I have to disclose as a financial advisor offering wealth management services through my firm, Martin Wealth Solutions. You should know that the opinions I discuss here are my own, and like the weather, they can change. The content I provide in the show is for general education purposes only. It's not meant or intended as specific advice, nor do I recommend any special financial products or strategies. You need to talk to a professional before taking action. I can't guarantee that my statements, opinions, or forecasts are always right. Past performance is not indicative of future results. I'm not an attorney, thank God, or a tax professional. And remember, all investing involves risk, including the loss of principal. There is no guarantee that any investment or plan will be successful. See you next week.